What do plumbing and hospice care have in common? Apparently a lot if you're Chemed. Welcome to Insightful Value, where we uncover companies that might just be flying under your radar. Today we're diving into Chemed, a lesser-known name with two very different businesses, and a stock price that's recently taken a hit. Is this a buying opportunity in disguise, or should investors tread carefully? Let's find out. This video is for informational and educational purposes only, not financial advice. Make sure to like the video and subscribe for more sharp, no-nonsense analysis. Chemed operates through two main subsidiaries, Vidas Healthcare, which provides hospice care services across the United States, and Roto-Rooter, the country's largest provider of plumbing, drain cleaning, and water cleanup services. That's an unusual combo, but it works. Chemed is a steady, cash-generating machine with decades of consistent earnings growth. So what's the issue now? The stock has been under pressure recently, partly due to concerns about reimbursement rates in healthcare and general investor caution around anything related to government funding. Vidas operates in a highly regulated industry, and changes in Medicare policy can have a big impact. On the plumbing side, Roto-Rooter has been a reliable performer, but labor costs and inflation have tightened margins a bit. Still, both arms of the business remain profitable. Chemed has a track record of solid fundamentals. Over the last 10 years, the company has grown revenue, earnings, and free cash flow steadily. Profit margins are healthy, operating margin is around 15%, and return on equity has hovered near 30%, which is impressive. It also carries relatively low debt, giving it room for flexibility in uncertain times. From a dividend perspective, Chemed is conservative but consistent. It has raised its dividend annually for over a decade, although the yield is modest, typically under 1%. The focus here is more on compounding capital and less on income, but the dividend growth shows confidence from management. So why consider Chemed now? First, the recent dip in price has pushed its valuation lower, potentially opening up an entry point for long-term investors. Its diversified business mix gives it stability, and its long-term growth in both the healthcare and essential services sectors is still intact. Second, its balance sheet and historical returns make it attractive for those who appreciate strong, predictable operators. But there are risks. Hospice reimbursement rates and regulatory scrutiny can impact Vidas's profitability. Meanwhile, any slowdown in home maintenance spending could affect Roto-Rooter. Chemed's unique structure also makes it hard to compare directly to peers, which can keep it underfollowed and misunderstood by the broader market. Overall, this is a classic insightful value type of stock. Solid fundamentals, temporarily out of favor, and likely ignored by the mainstream. If you're into companies with real cash flow and unusual business models that actually work, Chemed might be worth putting on your radar. For more in-depth breakdowns like this, head over to insightfulvalue.com. We simplify complex company data into actionable insights without the jargon. And remember to like this video and subscribe to our channel if you want more hidden gems like this one. See you next time on Insightful Value.